Hello fellow investor, welcome to the Arabian Century, the twin publication of cyclical value investing, both dedicated to help you navigate a quickly changing world and the rise of new Arabian power. In this video we will discuss three of the most important trading corridors in the world and how each could be fully closed or much more expensive to use for Western companies in the near future. The world economy is highly dependent on trade passing by the Middle East or around it, in not one, but three strategic choke points, each potentially at risk considering the ongoing war in Israel and the growing list of conflict in Eurasia. In this video, we'll see where these choke points are, why they matter, and which of the regional and international powers are working on keeping them open or trying to close them.
A vital trade route. The Middle East has been a crucial trade route since the dawn of civilization. It connects Asia to both Europe and Africa. This is where the Silk Road 1.0 was crossing, and where the Silk Road 2.0, now renamed Belt and Road Initiative, is currently being built by China. This has also been the center of intense diplomatic activity for a few years, with Iran, Saudi Arabia, the United Arab Emirates, Egypt and also Ethiopia recently invited to join the BRICS alliance. The three choke points. Geographically, the sea trade routes are passing by three vital choke points in the region. First, the Suez Canal in Egypt, connecting the Red Sea to the Mediterranean Sea, just east of the Nile Delta, which you can see on the map right now. Secondly, the Bab el-mandeb Strait, next to the Gulf of Aden and bordering Yemen and Ethiopia, connecting the Red Sea to the Indian Ocean. And lastly, the Strait of Hormuz, next to Iran, connecting the Persian Gulf to the Gulf of Oman and the Indian Ocean. This region is responsible for 34% of the global oil export, 56% of the global oil reserves, 30% of all global container traffic passing by the Suez Canal and the Bab el-Mandeb Strait, and 1/5 of the global liquid fuel is transported through the Hormuz Strait. This number is even higher if you add Hormuz and Suez combined. Troubled times. It is really no surprise that government and military all over the world are more than a little nervous when these sea lanes start to look like they might have a little bit too much action going on around them. Like, for example, when Yemeni rebels maybe land on a cargo ship with helicopter and commando to take control of it. What just happened on the 20th November 2023? Or the firing of two missiles at a US warship that was passing by like on 26 November 2023. And some more missile and drone attacks while I was still preparing this video. Still, oil price could not care about any of that, so should we? While the Yemeni have little to lose by interrupting trade, Egypt is in a rather different position with the Suez Canal. In June 2023, Egypt cashed in 9.4 billion from transit fees, an absolutely vital revenue source for a country permanently short of money. Egypt have also been less than pleased with the Israel-Gaza war right on its border. 7 people getting injured when an Israeli tank fired accidentally at the Egyptian border did not help matters. The idea of relocating 2 million Palestinian refugees in the Sinai Peninsula is also not something the Egyptian government is willing to consider. Meanwhile, the Strait of Hormuz is maybe the most discussed body of water in the world when it comes to geopolitical analysis. Still, for now, this is the least turbulent of the three, as none of the Persian Gulf oil-producing countries want to lose access to oil money, and that does include Iran. However, it is pretty clear that if the conflict with Israel turns into a large regional war, Iran will not tolerate to be blocked from exporting its oil, but letting the rest of its neighbors continue as usual. And the Strait of Hormuz is extremely shallow, meaning that any shipwreck will block further traffic for months or years, which would be pretty easy to do for Iran. Bricks by bricks. I mentioned at the beginning of this video the integration into the BRICS of Iran, Saudi Arabia, the United Arab Emirates, Egypt, and also Ethiopia. Together, these countries directly or indirectly represent all the major players in each of the three Arabian Peninsula choke points. Egypt controls the Suez Canal, Ethiopia do not directly control the Bab el-mandeb Strait, but is very active in the region, and the other strong actor of the strait, the Yemeni rebel and the Yemen government, are respectively backed by Iran and Saudi Arabia. And finally, Iran, Saudi Arabia and the UAE are the major players around the Gulf of Hormuz. With the fourth, Oman, the least powerful state there, but also very friendly to China as well. So when every single one of those countries join the same trading and diplomatic alliance at once, turning it from a disparate group of 5 into a much more coherent group of 10, and that alliance of the extended BRIC is essentially centered around China, this did raise a few eyebrows, especially in Washington DC. It would go beyond the scope of this video to do a full analysis of what is going on in the Middle East, who is doing what, and it is becoming more complicated than usual. And that's saying something. Let's just say that overall, a lot of regional actors are turning away from the USA and firmly moving toward China and Russia. And that does include Saudi Arabia and Egypt, not just Iran. The war in Israel is reshaping the Middle East, and so is the rise of China as a diplomatic and economic superpower, and the open alliance between Iran and Russia as well. Increasingly, Israel and the West seems to be getting less and less power relays in the region. Investing takeaways. The first thing that comes to mind is how little risk premium there is on the oil market right now, considering the risk of an expansion of the war in Israel. By risk premium, I mean the price on oil and gas taking into account the chance of a disruption of supply. As soon as there was no immediate full-blown war with Iran or the Hezbollah, the risk premium have melted away. In my opinion, this is very short-sighted. Honestly, this reminds me a lot of how our market reacted to the early stage of the COVID pandemic. At first, stock did not react to China going in lockdown. Should have been a big deal, but the markets ignored it. Or the breakdown of Italy's healthcare system. This was closer to home, but still not close enough. It's only when the virus hit New York that the investment bankers started to panic. Before, it was far away and out of their field of vision. I think the same is happening for energy market currently. As long as no mega oil tanker is set aflame off the Yemeni coast, we will keep pretending the risk is priced in. Of course, such an event might not happen, but the risks are definitely not zero either. Another risk is a repeat of the 1970s. This was also a period of high inflation and rising interest rates. But it could have been a footnote of financial history if not for the Yom Kippur War. While Israel mostly won the war against all of the Arab states combined, the retaliation of an oil embargo against the West by these Arab states got every Western country stuck in almost 10 years of brutal stagflation. For those not familiar with the term, stagflation is a mix between economic stagnation and inflation. No growth, rising prices. Does that ring any bell? And how symbolic of a message is the fact that the Hamas attack of the 7th of October was to the day, exactly 50 years after the start of the Yom Kippur War. All of this is happening in the context of other major oil producers alienated from the West, like Russia and Venezuela and Iran. And now the EU is discussing the possible embargo of Russian oil export in Danish waters. Maybe tomorrow through the Turkish Bosphorus Strait. Another major naval choke point controlling the entry into the Black Sea and Russian oil exports. So I would be very cautious to assume that inflation is under control, that oil supplies are safe and secured, and that a repeat of the energy shock of the 1970s is not likely. In my opinion, and I want to emphasize that this is not financial advice, just something that's on my mind, oil producers in South America like Petrobras or Ecopetrol are maybe in the best position to benefit from a potential oil shock. They are looking to grow production, are not so constrained by carbon emission and green policies as the West, and are also far away from the brewing wars in Eurasia. Offshore drillers with little exposure to the Middle East, and therefore the jackup market, are probably a good option too. Valaris and Transocean are companies that come to my mind. Oil companies in Europe like Equinor or Vår Energy, in a continent that would be the most affected by oil crisis, should do well in case of such an expanding war in the Middle East. Shipping company could be an option as well with rising rate, but this is a difficult sector and that boat might have already sailed. I'm not really sure and I'm not really an expert of that topic. And so that's it. These 3 choke points are probably the most important places in the world for investors right now. And they will determine if we are going to see a repeat of the 1970s stagflation or not. If you like this content, please subscribe to the channel and consider subscribing to my Substack newsletter, linked in the video description. I publish a free article approximately once per week and a premium report once per month. Until next time, stay safe, stay informed.